What's up my friends, Alfonso here. If you are watching this video, you may subscribe to this channel for regular market analysis and forex education. In this video, we are going to show you everything you need to know about trading forex from beginner to advanced level. What is forex? Foreign exchange market, which is usually known as forex or FX, is the largest financial market in the world. The global financial market that allows you to trade currency pairs. Over $6 trillion by volume traded per day. Forex is a decentralized market. It is everywhere. No central authority that governs it. It is made up of a network of banks, brokers, retail traders, and even governments who trade currency with each other. Forex market hours. Unlike the stock market, the forex market is open 24 hours a day for 5 days. The forex market opens 5 p.m. Sunday to 5 p.m. Friday Eastern Time. The major trading sessions in the forex market. The trading sessions will vary according to your time zone. There are 4 major trading sessions: Sydney, Tokyo, London, and New York sessions. The best time to trade is during the London and New York sessions, as there is much volatility and large trading volume in the market. For East Africa, Kenyan traders Nairobi time. For Kenyan traders, the best time to trade is from 11 a.m. to 5 p.m. as during this time, the London and New York sessions are active and overlap with each other. You will see the highest volatility during these trading hours. What is traded in forex? Currency pairs. When you trade in the forex market, you buy or sell in currency pairs. Currencies are always quoted in pairs, such as the euro and the US dollar, euro USD, or the British pound and the Japanese yen, GBP JPY, or the pound versus the US dollar, GBP USD. Currencies are traded through a forex broker. Categories of currency pairs. There are 3 categories of currency pairs: the major currency pairs, the cross currency pairs, and the exotic currency pairs. The major currency pairs always include the US dollar, like the euro USD, GBP USD, USD JPY, etc. As the US dollar is the world's largest economy. Starting out, I recommend sticking to trading major currency pairs because they are the most liquid, meaning you can get in and out of the trade easily and fast. Let's go to the cross currency pairs. Cross currency pairs do not include the US dollar. For example, GBP JPY. Exotic currency pairs. When one major currency is paired with a developing country currency, for example, the US dollar versus the Kenyan shillings. A summary: major currency pairs. Euro US dollar, a nickname of fiber. We have US dollar versus Japanese yen, a nickname of gopher. You have the pound versus the US dollar, nickname of cable. We have the US dollar versus the CHF. CHF is Swiss franc, so the nickname is Swizzy. US dollar versus the CHF. We have the AUD USD, Australian dollar versus the US dollar. Nickname is Aussie. We have the US dollar versus Canadian dollar. Nickname is Loonie. We have NZD USD, New Zealand dollar versus US dollar. So those are major currency pairs. Minor pairs, minor currency pairs. Euro versus the Great Britain pound. We have euro versus Japanese yen. We have pound versus Japanese yen. We have New Zealand dollar versus Japanese yen. We have Canadian dollar versus Swiss franc. We have Australian dollar versus Japanese yen. Exotic pairs. US dollar versus the Mexican and all that. Base and quote currency. The first currency is the best currency. The second currency is the quote currency. GBP is the base currency in this pair. US dollar is the quote currency. So let's say you have a quote of GBP USD. The first currency is the base currency. The second currency is the quote currency. The base currency is the reference for the exchange rate of the currency pair. It is always a value of 1. For example, in this quote, to buy 1 British pound, you have to pay 1.5143 US dollars. to sell 1 British pound, you will receive 1.5143 US dollars. So the base currency is the reference currency for the exchange rate. It is always a value of 1. You will buy the pair if you believe the base currency will appreciate, gain value relative to the quote currency. You will buy if you know that the GBP, the base currency, is going to gain value against the US dollar. You will sell if you think that GBP, the base currency, will depreciate, lose value relative to the US dollar. What is a pip? A pip is the unit of measurement used to express the change in value between two currencies. A pip stands for a price interest point, price movement. A pip is the 4th decimal place in US dollar pairs. Like for example, this one here. We have a price of 1.25791. So a pip is the 4th decimal place. This 2 is the 1st decimal place, 2nd, 3rd, 4th decimal place. So this 9 here, right here, a pip starts from here. This 1 pip, then this 7 here, this 10 pip, then here 100 pip, then at this 2 we have 1,000 pips, then at this level 10,000 pips. This is 10,000 pips. So a pip is the 4th decimal place in US dollar pairs. This 5th decimal place is called a pipette. We are going to discuss it. For example, if euro US dollar moves from 1.1050 to 1.1058, that is an increase of 8 pips. That is an increase of 8 pips in value. I say that a pip is the 4th decimal place in US dollar pairs. So this is the 1st decimal place, the 2nd decimal place, the 3rd decimal place, and this 8 is the 4th decimal place. So 8 minus 0 is 8 increase in value. Example 2. If euro US dollar moves from 1.3400 to 1.3350, that is a decrease of 50 pips from 400 to 350 right here. So a pip is the 4th decimal place. You count a pip as you go from 4th decimal place as you come forward. So this is the 1st decimal place, 2nd decimal place, 3rd decimal place. So 400 minus 350. So that is a decrease in 50 pips. So pips helps you to calculate profits or losses in the market. Pips will help you to know the movement of price from a certain point to a certain point. That is how you calculate your profits and losses. There is a special case, Japanese yen pairs. The pip value is the 2nd decimal place for Japanese yen pairs. For example, if US dollar versus Japanese yen moves from 100.10 to 100.15, so the 2nd decimal place is the pip. So 15 right here minus 10. So that is an increase of 5 pips. For example 2, if US dollar versus Japanese yen moves from 100.50 to 100.10, that is a decrease of 40 pips. 50 minus 10 right here. So US dollar price was at 100.5, then it moves to 100.10. It depreciates the value by 40 pips. What is a pipette? This is a fractional pip, a tenth of a pip. It is the 5th decimal place in USD pairs. For example, GBP USD moves from the price of 1.3054. This raise power right here, you'll see it in trading platform that it is raise power. This raise power, this red tool right here, these are pipette. It's the 5th decimal place, the 5th decimal place in USD pairs. So if GBP USD moves from this price right here to this price right here, a move from 2 pipette to 3 pipette. So 3 pipette minus 2 pipette is an increase by 1 pipette, which is 0.1 pips. So pipettes, we always don't consider it so much because it doesn't affect not that much of impact. A pipette in Japanese yen pairs, it is the 3rd decimal place. Another example of pips and pipettes. So here we said that a pip is the 4th decimal place. This is the 1st decimal place, 2nd decimal place, 3rd decimal place, 4th decimal place. So you start counting from here, from 6 pips, 80 pips, 1,000 pips, 10,000 pips. So a pipette is this fifth decimal place, 0.3 pips or 3 pipettes. What is a lot in Forex? Basically, the number of currency units you will buy or sell. So we have different lot sizes. For one standard lot, we have 100,000 units of currency, 100,000 units of the base currency. For mini lot, we have 10,000 units of the base currency. For micro lot, we have 1,000 units of the base currency. For nano lot, we have 100 units of the base currency. So majorly, we focus on standard lots, mini lots, and micro lots. This nano lot is a minor. So one standard lot is 100,000 units of currency. So the volume of one standard lot, so the value per pip, if you are trading a volume of one lot, the value per pip, if a pip has moved by 40, the value per pip is $10. So 40 times 10, that is $400 in profit. So if you are trading a volume of one standard lot, you are controlling a volume of 100,000 units of currency. That is one lot. So the value per pip is $10. For mini lot, it is 10,000 units of currency. So if you are trading a volume of 0.1 lot, the value per pip is $1. For micro lot, you're controlling 1,000 units of currency. If you are trading a volume of 0.01 lot, the value per pip is $0.1. You can trade fractional lots. What is leverage in Forex trading? Leverage is the ability to trade large amount of money relative to your account size. It enables traders to borrow capital in order to gain a larger exposure to the Forex market. Leverage example. Leverage is always represented as a ratio in the Forex market. For example, a leverage of 1:10, a leverage of 1:100, a leverage of 1:50, 1:400, 1:60, 1:10, etc. For example, if I deposit a $50 account using a leverage of 1:400, my buying power will become 400 times 50, which is $20,000 trading volume. So leverage is just the account size multiplied by the leverage size, which is $50 multiplied by 400. So your account size multiplied by the leverage. Leverage can amplify your profits or losses. Let us see the power of leverage. So if, for example, I have $100 of capital in my account and using a leverage of 1:20, that is my account size multiplied by 20. So 20 times 100, which is 2,000 buying power. So I'll access a volume of $2,000 in the market. So leverage is the ability to trade large volume in the market relative to your account size. Ability to borrow capital. This leverage, you don't return it and you don't lose it. You only lose what you deposited in your account. It is provided in the broker platform. So another example is using a leverage of 1:50 and I have $100 account. So 50 times my account size, which is $100. So I'll be having a buying power of $5,000. I'll access a market volume of $5,000. So let's say I use a leverage of 1:100 and my capital is 100. So 100 times 100 is 10,000 buying power. So the volume of the market I'll be able to access is 500 times 100, which is 5,000 buying power. So leverage can amplify your gains and losses. So you use leverage carefully. What is risk management in Forex trading? Risk management is the ability to encounter a series of losses without blowing up your trading account. Blowing up simply means losing all the money. If you learn how to control your losses, you will have a chance of being profitable. Risk per trade should always be a small percentage of your total capital. What is position sizing? This is trading the right number of units according to your account size. So how to calculate position size is equals to amount to risk over stop loss times value per pip. So risk management is determined using position sizing calculator, and position sizing calculator you can find it on Google rather than doing it manually. You just search position sizing calculator, you'll find it on Baby Pips or anywhere else that they offer, so that you can know the right lot size that you're going to use for your account size. Types of forex orders: we have market order, we have buy limit order, we have sell limit order, we have buy stop order, we have sell stop order, stop loss orders. So types of forex orders: the first one is market order. Market order is a market execution instantly. You enter the trade instantly. Tell your broker that I want to enter the trade instantly. This is the one you majorly use. This is the one we majorly use. But pending orders, like buy limit orders, these are pending orders. You set a certain price, telling your broker that I want to enter a trade when the price reaches a certain point, or I want to exit a trade when a price reaches a certain point. So these are pending orders. So pending orders: one, buy limit. Buy limit, limit price is set lower than the current market price. Sell limit, limit price is set higher than the current market price. Buy stop order. Buy stop order, you set price above current market price. So order to buy above current market price, that when the price reaches that point, you enter a trade. We have another one, sell stop order. You set price below current market price and order to sell below current market price. You tell your broker that you want to enter a trade if that price reaches a certain point, you sell. We have stop loss order. This is an order to get you out of a losing trade. The two types of prices in the forex market: bid price, this is the price you can sell at, this is the selling price. Ask price, this is the price you can buy at, buying price. What is spread? Spread is the difference between the bid price and the ask price. Spread is the difference between the buying price minus the selling price. Spread determines your transaction cost for placing a trade. So spread varies according to broker and different market conditions. So to reduce the cost of spread, focus on major currency pairs. Example of spread: so let's say this is a trading platform, and this is the selling price, the bid price, and this is the buying price, the ask price. So spread is the ask price minus the bid price, the buying price minus the sell price. So don't confuse spread with pips. Spread, you subtract this minus this, so you'll get 0.0006 spread, which is 0.6 pips. Types of forex traders: so there are different types of forex traders. One, a scalper. A scalper is somebody who opens positions and closes within seconds or minutes. You just enter a trade and get out immediately. You take small profits and get out. That is a scalper. We have a day trader. A day trader is somebody who opens and closes trades on a single trading day. Like you open a trade in the morning, in the evening before you go to sleep, you close your trade. You are a day trader. We have a swing trader. Swing trader is typically holding trades between 1 to 4 days or many days, holding trades for days. So a swing trader is somebody who holds trades for days. We have a position trader. A position trader is somebody who holds trades for months or even years. Scalping requires much sensitivity in the market, so scalping needs pros. At scalping, if you are able to know how to scalp well, you can get small amounts of profits each and every day and get out. So scalping leaders are most volatile pairs. Like for example, Euro USD is a major pair, so it is volatile, so it's easy you get into the market quickly and get out. Also XAU USD, XAU is gold, so gold versus the US dollar. So XAU USD is very volatile. That is why it's the leading scalping currency pair. So if you are scalping gold, it's a risky pair, and it has a lot of volatility, so you must be careful in trading gold. So if you want to get money quickly, trade gold. If you want to lose money quickly, trade gold. How to read candlesticks, also known as Japanese candlesticks. Green candlesticks are bullish, representing buyers in the market because prices appreciated and went upwards during the time period. Red candlesticks are bearish, representing sellers in the market because prices depreciated and went downwards for the time period. The rectangle, green and red areas is the candlestick body, or representing the real body. The lines that stick out of the candlestick body are known as wicks or shadows or tails. This is the upper wick and these are the lower wicks. These are the lower wicks. For green candlesticks, the opening price is at the bottom of the candlestick body and the close price is at the top of the candlestick body. For red candlesticks, the opening price is at the top of the candlestick body. The close price is at the bottom of the candlestick body. The wick ends at the top represents the highest price point of the time period. The wick ends at the top represents the highest price point of the time period. The wick ends at the bottom represents the lowest price point of the time period. Candlestick psychology. What does the size of candlestick body tell us? The bigger the candlestick body, the greater the momentum gain. The smaller the candlestick body represent momentum loss. So the first candle, strong buying momentum. The middle candle is called a doji. It is called a doji. It represents indecision in the market. Let's go to the sellers. This is very bearish. So why read candlesticks? Candlesticks tell a story of what buyers and sellers are doing. Traders look at candlestick patterns to make trading decisions, which is also known as price action. Market structure. Market structure helps us to know the current market condition, to know whether to be buying or selling or staying out of the market. Types of market structure. Uptrend, a bullish market structure. You should be looking for buying opportunities. Downtrend, a bearish market structure. You should be looking for selling opportunities. Then we have a ranging market structure or sideways or choppy market structure. You can both buy or sell. Uptrend, bullish market structure. Look for buying opportunities. A bullish structure forms a series of higher highs and higher lows. So it will form a series of higher highs, higher low, higher high, higher low, higher high, higher low as you continue. So this is a typical market structure, a typical bullish market structure, uptrend market structure. So uptrend, you should be looking to buy. So forming higher high, higher low. So you will be looking at a key level which is higher low. Somewhere here you look at the candlestick formation and loss of momentum from the sellers. Then you look for buyers momentum and enter for a buy. So price moves up, higher high, then a retracement, then higher high, then a retracement, then another higher high. So price cannot move straight in a straight line to the upside. It has to move up, then a retracement, then moves up, then a retracement, then moves up again. So you will look for buying opportunities at the retracement level. You should not be looking to sell, but you should be looking to buy, because if you look to sell, you will lose a lot of money trading against the trend. Always trade with the trend. The trend is your friend. A downtrend market structure, downtrend or bearish market structure. Here you should be looking to sell. Look for selling opportunities only. Forms a series of lower lows and lower highs. It forms lower low, lower high, retracement, then a push face, lower low, then a retracement, lower high, then another push face, lower low. So this is a typical downtrend market structure. This is a lower high, forms a lower low, a retracement, a lower high, then lower low. You should be looking to sell. You see there are red candles, which means sellers. There are many red candles than green candles, which means sellers are in the market than buyers. So this is a downtrend market structure. Ranging market structure, ranging or sideways market structure. Can both buy or sell. You can both buy or sell in this market condition. It is also called consolidation market structure. It often characterized by indecision in the market, indecisive price action. There is low trading volumes also, a choppy market, making it difficult to trade. So it forms sideways. It forms equal highs and equal lows. Sometimes it might not be equal highs, but it forms a ranging market structure. Market structure cannot be perfect, but you will just see and know this is a ranging market structure. So we will analyze other markets. We are going to analyze markets so that you can see how a ranging uptrend and downtrend market structure forms. Summary: a downtrend market structure, you should be looking for selling opportunity. A ranging market structure, also known as choppy or sideways, you should be looking to buy or sell, but always stay out of the market in a ranging market structure, because a reversal to an uptrend or a downtrend must take place. An uptrend market structure, you should be looking to buy opportunities. Market analysis. Types of analysis: we have technical analysis and fundamental analysis. Technical analysis looks at purely at price action, what the market is doing, and ignores the noise created by news and economic data. So that is technical analysis. So we are going to do technical analysis in the price chart. Fundamental analysis, type of analysis. So this takes a more rigorous assessment of the core fundamentals of a currency that may drive demand. So this includes the economic data. A combination of technical analysis and fundamental analysis considers both technical and fundamental aspects when assessing trading opportunities for a much more balanced view. So technical analysis, all traders use either of these methods or a combination of them. So we have price action, study movement of price, understand why prices move, includes candlestick patterns. We have technical indicators, so applies math formulas, includes moving averages, stochastic indicators, Bollinger Bands, or charting, which are just plotting trend lines, channels, which we will do. So we will do a technical analysis and you see how technical analysis is done. So that is a type of market analysis. So price action is king. Look at the market and doing what the market is doing is what we call price action. Study movement of price, looking at the candlestick body formation, that is what we call price action. Understand why prices move, include candlestick patterns and chart patterns. How to indicate market structure. Pay attention to price action. You can understand the market structure by analyzing market movements and candlestick patterns. Look at key levels. Identifying support and resistance level can help give you an idea of market structure. Assess market trends. Identify the direction of the market. Use technical indicators. Indicators such as moving averages can help you, RSI. So you can learn how to use these indicators, but always use price action, because price action tells you what is happening currently, because indicators lag. Indicators are things that rely on historical price data. So always depend on price action. Pay attention to price action. Price action, you can understand the market structure by analyzing market movements and candlestick patterns. So using technical indicators, there are people who use it, but it is lagging. But always try to implement price action in your trading analysis. So consider market volatility. High volatility indicates structural changes in the market. Key areas of value in the market structure. So this tells us where to buy or sell. So first, we have different key areas of values in the market structure. We have support and resistance, or demand and supply zones. So we have support and resistance. So these are key areas in the market chart. So support area is the demand zone, a psychological area on the chart where buying pressure is likely to set in. Support is a psychological area in the chart where buying pressure is likely to step in. Support area or support zone is also called demand zone. Demand zone is aggressive buying. So an area on the chart where you know that there is a lot of buying pressure, that is where we call support. Resistance is supply area. This is a psychological area on the chart where selling pressure is likely to step in. So resistance is a supply zone. Supply is simply aggressive selling in the market, a certain point in the market where selling pressure could step in. That is a resistance. So these ones we will draw them on a live chart. We'll draw support and resistance zone so that you can start analyzing the market and know how to draw support and resistance zones, demand and supply zones, and all that. So entry trigger will tell you if you can enter the market or not. Entry trigger, you will use candlestick patterns, which will help you to know if they are sellers or they are buyers, so you should be looking to sell or to buy. So that is entry trigger. You can use candlestick patterns. Let us go to the live chart and show how these key areas are drawn and how to analyze the market, how to draw support and resistance, how to know the market structure and all that. So we are going to the live chart. Live chart, I'm using TradingView. TradingView is a trading platform you can get for free. So my friends, this is the trading platform that we use to analyze the market. So you can get it for free on Google. Just type tradingview.com. You will be required to create an account with them. After creating an account, you can just start practicing analyzing the market. So I want to show you how to analyze the market and identify market structure, how to identify support and resistance. So right here on the top, right here you can see a pair Euro USD. So this is a widely traded currency pair. So as you can see above here, we have time frames. So 1M, 3M, which means 1 minute, 3 minutes, 1 hour, 1H, 2H is 2 hour, 4H is 4 hour, D is daily, W is weekly. So as you can see right here, this is the chart of Euro USD in a daily time frame. So if I press this D, it means that each and every candlestick that you see right here, it has taken a day to form it. Like if I see this red candle right here, this red candle right here, it has taken a day to form it. So this is a live market chart. It has taken a day to form each. If you come to the charts, what you have to do, you have to identify the market structure. First of all, you know different kinds of market structures: uptrend, downtrend, and ranging market structure or consolidating market structure. You always prioritize analyzing your market structure on a higher time frame so that you can get the bigger picture of what the market is forming. I always start identifying my market structure on a daily time frame or a weekly time frame to get the bigger picture. So you can go to the daily time frame, press that D, then as you look at this, you can zoom out so that you can get that bird's view. So if you zoom out in this daily time frame, you can see right here, you can do a research how to use TradingView, or I'll do a video to show you how to use this platform. So at this end right here, these are drawing tools. So these drawing tools help you to analyze market. So what we are doing now is called technical analysis. If I take my trend line right here, this is called trend line. This line right here, it is touching. So at least it is touching this point right here. Let me use this arrow. So it is touching this point right here. It is touching this point right here. So there must be at least 2 touches on that trend line to be valid. There must be at least 2 to 3 touches on that trend line to be valid. What market structure is this? I've identified on a daily time frame that right here, this is a downtrend market structure at this point. So price was going down, forming lower low, lower high, lower low, lower high, lower low, lower high, lower low, and price broke our trend lines. You go to the higher time frame so that you can get the outlook, the bigger picture of the market structure. So you know different kinds of market structure. After getting the bigger picture, you scale down to smaller time frames as you continue analyzing the market. That is what we call top-down analysis. So after me identifying, let's say for example, I identified this market was a downtrend. What should I be doing? I should be looking to sell. So lower low, lower high. So at this retracement, this is where I'll be looking for my sales. There were so many sellers in the market. There was a lot of selling pressure. That's why the market was in a downtrend. So that is an example of a downtrend market structure. Another example of an uptrend. So right here, guys, right here is an uptrend trend line. Drawing my trend line from down to up, at least 3 touches. Here is 1 touch right here, 1 touch, 2 touch right here, 3 touch right here. So 3 touches. So this is my trend line. This is an uptrend market structure, a bullish market structure. After drawing my trend line and I've seen it is an uptrend market structure, I'll only be looking for buys. So it is forming higher high, higher low, higher highs, higher low, higher high, higher low, higher high, right here, higher low, higher high, and it failed to form a new higher high right here. It failed to form a new higher high. The market just came down and broke the previous low. You change your focus that the market is changing the trend from an uptrend to a downtrend. So that is how you analyze the market in the bigger picture. Another downtrend market structure. Another downtrend market structure is right here, guys. So if I zoom out, you can see this is a downtrend market structure right here. So I take my trend line, draw it, connect at least 3 touches, at least 2 touches for the trend line to be valid. So that is what we call trend line. So after drawing my trend line from top here, so 1 touch right here, 2 touch right here, 3 touch right here, and 4th touch right here. So this is a very valid trend line. So this is a downtrend trend. This is a bearish market structure. It forms lower lows, it forms lower lows, lower highs, lower lows, lower high, lower lows, lower high, lower low. So as you can see, market broke our trend line and we shifted to an uptrend market structure. So you must be open-minded and know what is happening to the market. So this is called pure price action. You look at what market is doing, then you react to the market. Remember, make it simple for you to understand. Trading is not complicated. If you make it complicated, you'll lose a lot of money. This is GBP USD currency pair, and I want to analyze this market. So I zoom out, I come to a higher time frame. Like if you go to 4-hour time frame, if you hit the 4-hour time frame, it has taken 4 hours to form each and every candle. Like this red candle right here, it has taken 4 hours to form it. If you scale down to 1-hour time frame, each and every candle that you see right here, it has taken 1 hour to form it. Each and every candle. This candle, it has taken 1 hour to form this candle. So if you go to smaller time frames, there is too much noise in the market. So that's why we are advised to analyze our market on higher time frame, because there is less noise. There is so many candlesticks being formed in the lower time frame. So you analyze your market on higher time frames so that you can get the bigger picture, the bigger outlook, what is happening on the market. You identify the market structure. That is the first thing that you do. After identifying the market structure, put your buyers. Am I buying? Am I selling? Or am I staying out of the market? An example of a ranging market, consolidating market. So a ranging market or a sideways market, there is both buyers and sellers. Let me draw right here. So it is ranging from this zone right here, ranging from that zone, ranging from this zone right here to this zone right here. It is ranging from that zone right there to that zone right there. So this is a form of a ranging market structure. A ranging market structure. You can both buy and sell. You buy at support, you sell at resistance. So this top line right here, this top rectangle that I've drawn right here, this is called resistance. Resistance is where there is much selling pressure. It is a key level on your price chart. There is a lot of selling pressure. You will anticipate if the price touch right there and failed to go up, you anticipate that in the near future, when price is coming back to that point, you expect a reaction to the downside. There are sellers interested at that area. So that is what we call resistance. Price fails to go above their zones. So all this zone right here is a resistance zone, because as you can see, price touched it 1 time, 2 times, 3 times, even 4 times. So which means this is a very strong resistance zone. Resistance zones, we also call them supply zones. Supply zones simply mean aggressive selling in the market. When price came up to retest this level, price went down. Price came up again, failed to cross it, so which means it's a very strong resistance zone. So price came again right here, and you can see a very strong selling pressure right here up to this point. So this is what we call a resistance zone, this top rectangle that I've drawn. So down here, this down rectangle that I've drawn, it is called support zone. So price came to this point and went up. So support zone, we also call it demand zone. Demand zone is aggressive buying, a point of interest on your chart where there is a lot of buying pressure. So right here, price came here and went all the way up. So you are interested on this zone right here. In the near future, if price comes again to this zone right here, you draw your rectangle that way. This using your drawing tool, you draw your rectangle. Then you anticipate that when the price comes back to this zone right here, you will expect some buyers seated here waiting to buy. Let's say you drew this earlier before the price reached here for the second time. So after drawing it, you look at the momentum of candlestick formation right here on a lower time frame. After identifying the market structure, you go to the lower time frame like 1 hour. See, when I go to the 1 hour time frame, there is so much noise, there is so many candlesticks being formed, because each and every candlestick that you see right here, it has taken 1 hour to form each and every candlestick that you see here. That's why there is so much noise in this market right now. If you are a day trader, always focus on analyzing. Don't look at what the market did here. This is too far. Look at what the market is currently doing. Mark key zones near the current price. Right here is the downtrend market structure right here. This was a downtrend market structure. At least how many touches? 1, 2 touches. Then price came with a big bullish momentum and broke our trend line. Now we shifted to an uptrend right here, but now price started consolidating right here. If you zoom out, you see price is consolidating a sideways market structure. Guys, always stay out of the market if you can't trade a sideways market structure, because you don't know when the market will break the resistance zone up here or break this support zone right here. So which market structure is this? You can zoom out and look at what the market is doing currently. After marking my key level, my trend line, I mark my key level. So this was a resistance zone right here. This was a resistance zone right here. So this is a zone. You just mark it that way. So this is a resistance zone right here. Right here, this is the resistance zone. Price broke the resistance, came and retested the resistance. Price broke the resistance became support. So price came and retested it again. So there are many buyers seated around here. There are buyers seated around here. So here, this is a confirmation that there is a lot of buyers at this point. So this is a long week rejection. So at this key level, this resistance zone which became support, it is now a key level. So candlestick patterns. So candlestick patterns that give signals when they form at key areas. This is a bullish engulfing candlestick pattern. So a bullish engulfing, you see this red candle is smaller than this green candle. So this green candle has engulfed the red candles. So if a bullish engulfing candlestick is forming at a key area, you should be looking to buy. Let's say this is a support area. So if a bullish engulfing candlestick is forming at a support area, you should be looking to buy. Then let's say this is a resistance zone. A resistance zone is where sellers are seated. Sellers, there are more sellers here. There is aggressive selling pressure at a resistance zone. So this is a key area, a resistance zone. And this is a bearish engulfing candlestick. So this green candle has been engulfed by this red candle. So the red candle is bigger. The red candle's body is bigger than the green candle, forming at a resistance zone. So you should be looking to sell. You should be looking to sell. So that is a bearish engulfing candlestick. So these are candlestick patterns that you should put key interest into, because they will tell you when to enter a trade and when to exit a trade. So bullish engulfing candlestick and bearish engulfing candlestick. So we have different candlestick patterns. I said the first one is bullish engulfing. This green candle, bullish engulfing, giving you a buy signal, a buy opportunity. If it forms at a key level, you will be looking for buys. So bullish engulfing. Then we have morning star. Morning star, this is a formation of a bullish, gives you buy signal. When it forms at a key level, gives you a buy signal. This is a morning star. Then this bullish pin bar, a bearish engulfing. Bearish engulfing, if it forms at a key level, you should be looking to sell. So this one are telling you to sell if they form at a key level. You just look at candlestick momentum at a key level, and if you see this candlesticks pattern being formed at that key level, then you will be looking to sell. These are bearish engulfing, telling us there is a lot of selling pressure and you should be looking to sell. So this is an evening star telling us you should be looking to sell. Bearish pin bar, bearish harami. So these candlestick patterns, you will be knowing them as you continue practicing and trading. It's not a must that you master all of them, but you can master few, like the bullish engulfing, bearish engulfing, evening star, and morning star. So these are my favorite. So market analysis still, downtrend and uptrend. So I said a downtrend market structure forms a series of lower low, lower highs. You see, lower low, lower highs, lower low, lower highs. Then there is a support level right here forming lower highs, then broke that support to the downside. So this is a ranging market structure or a choppy forming sideways. This formed sideways, signifying a reversal in trend. Downtrend, we are reversing from downtrend, now we are going to uptrend. So choppy market or sideways or ranging market or consolidation market signifies a trend reversal, majorly signifies a trend reversal, or sometimes it is a trend continuation, but majorly a trend reversal. So this from a downtrend to a ranging market, then an uptrend formation. Uptrend forming a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So I said on an uptrend market structure, you should only be looking to buy, and you buy at higher lows. So confluence simply means confirmations to enter a trade. Confluence. So this is an uptrend market structure. An uptrend market structure forms a series of higher highs, higher lows, higher highs, higher lows. And in an uptrend market structure, you should only be looking to buy. You should only be looking for buying opportunities. So we said this is a zone, so forming higher highs. So market came to this point, formed higher high, then higher low, broke this previous high. After breaking it, it came and retested this previous high. After retesting this previous high right here, it went up, then another retracement. So this level right here is a support zone. There is a lot of buyers pressure at this zone. So these are key interest points. So these are key area that you should be looking to buy, as you can see. So this is a typical example of how a market forms. Then a massive bullish candle giving us a confirmation that we should enter for a trade. Resistance always becomes support. After the resistance is broken, at some point it becomes support. So you have different confirmations that you can enter for a buy position. So that is how you enter a trade. An example for downtrend market analysis: price before going down, price is forming a ranging market. Forming a ranging market. This is a choppy a ranging market up here. Resistance at the top, price failed to break this zone. Resistance, there are a lot of sellers at this point. Then support at the bottom. So after this consolidation, so price broke it with a strong bearish momentum to the downside, as you can see. So at the support level, price broke that support level with a strong bearish momentum. So wait for a retest for this level. So after breaking it, it will become resistance. Different types of market structure and how you can analyze them. So you can screenshot this, or you can pause this video and understand. You are not supposed to master all these candlestick patterns in order for you to become profitable. No, you can master 4 or 3 candlestick patterns when you see them forming at a key level. These are the candlestick patterns that can help you to enter a trade at a key level. So with time, with practice, you'll get to know which ones work for you. So placing a trade, you will need a good broker, then link your broker account to the trading platforms. Before placing a trade, you need to analyze your market, and this can be done on tradingview.com. You create an account and get a free version and start practicing. The trading platform you will install from App Store, that is MetaTrader 4 or MetaTrader 5. Normally we call them MT4 or MT5. MT4 is simple to use, just for beginners. MT5 is quite advanced. More on this is done by practicing. If you want to become profitable, you have to come up with your own strategy, or you can implement other people's strategy and make it work for you.